Hello, fellow traders. 'Tis I, the Rumpled One, coming to you Tuesday, November the 19th, the year 2019. Let's talk trading. Developing a method. More information equals worse results. It's counterintuitive. Usually you think when you need to make a decision, the more information you have, the better, right? Well, that's not always the case. In fact, those of you who've been watching my videos for a while or following me for years know about the rat versus the Yale student. Well, I was chatting with a trader over the internet this morning, and he said something, and then of course I countered with, I'm a green rat. Um, you know, Part of developing a method and part of developing a strategy is to minimize the variables. So in my case, most of the time I only trade the dollar yen. And most of the time I only go long. I'm a green rat. And most of the time, I stick with the reversals. Okay? Coming off a bottom, going long. And I have much better results than trying to decide which way is price going or which pairs are hot, which pairs are cold, and all of those things. So I stumbled across another talk, and actually this is over almost 15 years old, 14 years old, about the rats. And I don't know, let me see, can you see that link? I'm not sure if you can see the link, but I will post it in the comments in the video in case you want to read it for yourself. But you can see it has some charts, graphs there. But the thing is, why does more information make for worse performance? Because sometimes you'll use information to filter out possible gains. I mean, when it comes to a horizontal line trade, you've got one of two choices. You either enter as in the price, the direction price is crossing the horizontal line because that makes sense. Or you can possibly go the other way. I guess there is a third option. You can do nothing. You can wait, say, nope, I don't want to take this trade at this time. So when you look at screens and you look at methods out there, just keep that in mind. I have a rule of thumb. If you can't write your method on a 3x5 index card, 3 inch by 5 inch index card, it's too complex. As Deming says, if you can't explain what you're doing as a process, you don't know what you're doing. And so just kind of keep that in mind. And of course, you always keep your money management and risk management in mind. Yes, the method's important, but in order of importance, your risk management and probably, your execution and performance, because it doesn't matter what method. If you're not executing it properly, when you should, how you should, then your performance is going to suffer. It just is. And of course, you cannot lose more on any given trade than you're willing to lose because you don't want to get taken out of the game. Now, fellow traders, you have to remember one thing. These videos are for educational purposes only, and your results may differ from my results. And always keep in mind that trading is extremely risky and you can lose all the money that you put into your portfolio. Because of this, if you need financial advice, financial guidance, seek it from an accredited financial professional. That way, if you take their advice and lose all your money, you know it came from an accredited financial professional rather than somebody you stumbled across on YouTube or email or some other place on the internet, or got some tip from some guy you overheard in an elevator or taxi cab or airport or something. Okay, we got the disclaimer out of the way. I was talking about developing this H4 method. Now, this is like perfect. I couldn't ask for better example here. I mean, I'm looking at this chart, and what do I see? I see a long opportunity. You may wonder why, because I see what happened here. Price went up. Here, price went up, up. So here, price was going up. Here, up. Yeah, it cut down once. It cut down twice. Cut down 3 times, but it seems to keep going up from this area. So even though we're down 19 pips on the day, we're 58 pips off the high. We're in that lower rat zone here. So actually, this is 58 pips from yesterday's high, D1. So we're below yesterday's open, which means we broke out of the previous day's wick zone. But I just like the way it's sitting here on the H4 chart. And if you scrunch down the H1, you can see it a little more granules there. And that's just, I'm going to wait for a reason to enter the trade, and then I'm going long, because probably I would imagine this is H1. This looks like the H1 low of the day, H1 low of the week. See, just having a couple of these horizontal lines and nothing else, that's less information, but it's more than enough for me to make trading decisions. Of course, yes, I am looking here, and I've got tons of indicators, and there's other people that have written indicators that can indicate, what's going on at this level. But I mean, I just like where it's sitting there. So let's see, let me go here. Once, just so you know, reason I like to go long the yen, positive swap. You can be making, maybe making $2 a day in swap, 20 or 200, depending on how many lots you're trading. It's a nice opportunity to cash in. And on the H4, you can see it hasn't even gone up yet, but I am of the belief that this is going to go up based on statistics. It's not a probability, it's a statistic, as I explained before. And here again, looking at the H1, you can see the high minus open frequency distribution. I could probably get 3 pips. I might be able to get more. We'll just have to wait and see. For those of you sent donations for the 2019s, I messed up when I sent out batch 5. I neglected to put in the updated TRO 2019 TRO dashboard, and so I had to send out the correction. And when I did, it came with this new indicator here. So you've got it, but I hadn't documented it yet because I'm still in the testing phase. So you guys all get to be guinea pigs. So this candle pattern here, and I showed you which bar you're going to start counting on. I like to use the previous bar. And here, -1 means you're going to look for a red candle. 1 means green candle. 0 means no candle. So here you have 4. Once again, if you put a 1 or -1 after 0, indicator's not going to see it, because that's the way I coded it. So let's go and look at the charts that we normally look at here. Let's see, what do we have? Monthly, weekly. Weekly. 1, 2 gaps haven't filled yet. So there was a couple more. I hope some of you traded that profitably. We're in that lower wick zone again, 5 pips off the weekly low here, 6 pips now. 114 pips below the weekly open. Now, the other thing about less is more, I show you many different methods. And for example, and the dashboard has 124 functions, but try to keep it down to a handful, 5 or less. Otherwise, it's just going to be an overload of info. And just try and stick with one method. Don't try to combine them. Master one. And if you get that down, you might not ever want to switch. But then after you master one, you can do a second one. So right here, you can see we've got the high, low for the year, high, low for the, not for the year, for the first day of the year, first day of the week, first day of the month. So now you can see there was a slight breakout of yesterday's low, good for about 6 pips. But now prices crawled back in to that opening range. The opens, you can see how many opens prices above versus prices below for the first day of the month. And you can see here where it is in the ranges for the month, opening day ranges. Okay, inside bar alert. We are still inside this bar, so look for a break either at the top or the bottom. We're inside that weekly bar again. Inside bar, that is. Only 3 pairs with the range exceeding 100 at the moment. In fact, there was an article out there about how the ranges aren't what they used to be, but that doesn't mean you can't take pips. You just have to narrow things and be happier with less. Right here you see the weekly H1 lowest open. We came across it. That was a nice trigger to be long right around 108.50, 108.49 area. Buy zone, okay. Pivot was inside the buy zone, so no strong bias there. Therefore, just taking the trades as they presented themselves. And once again, because of the contracted trading range of this particular pair, you have to settle for less. So here we crossed the weekly open. You see we failed to even go up, so that was either a couple of pips or a scratch trade. And then if you like to be a red rat and you short it, that was a nice trade to the south. And you had a second opportunity if you missed the first right here. Once again, this trade, you want to trade short against the weekly open, but long against the daily. But when they both match, usually you're good to go. But remember, it's trading. Anything can happen. Okay, we've got a green rat reversal happening right here. And on the pivots, the trader I was chatting with was saying, why not just trade all these pairs if they're all hitting the pivot so much, or trade all the pairs maybe on the weekly gaps. The thing is, you don't know if that one pair could take out everything else. I gave him the example. Oh, I can't remember how many years ago. It's probably been over a decade when the Swiss bank came out and did a reset or something, and the Swiss franc dropped 500 pips. I was lucky. I happened to be short. That was a very nice trade. But you can see here, we did take out that pivot. There's the weekly S1, weekly R1. At the rate we're going, I don't think we're going to see either one of those. But anything could happen. You just never know. We hit the pivot. So, fellow traders, I'm going to wrap things up with that. Just remember, less is more. You don't need a bunch of indicators hiding price on your chart and a bunch of squiggly lines above, through, and below your chart. You just don't. Because remember, it's not what you trade, it's how you trade it. So go out there and drain the banks.